Stephanie, always great to see you and kick off the week with you. I want to start by chatting a little bit about bonds and that move we saw. We've seen over the past 10 days, we were down at 1.76, 1.77. Now we're above 2.1. Why?
Inflation, and it's good to see you, Tyler, always. Inflation. It really comes down to that, and it's the unknown whether or not the Fed can catch up. They're behind the curve, right? So we got the CPI number last week. The headline was hot at 7.9, but it was the rent numbers that actually are a little bit troubling at 4.7% year over year, and the Dallas Fed is now suggesting 6.9% by the end of 2023. So that's more permanent parts of inflation. That's why I keep an eye on that, and we talk about that in wages as well, and they're going up. And you mentioned the PPI tomorrow. It's going to be hot, and it's going to be even hotter next month when it reflects what oil has done. So Fed, that brings me to the Fed, and you mentioned it, the FOMC meeting on Wednesday, and it's going to be 25 basis
and you've
points.
Also
but
got,
watch the dot plots and the.
You've also got that big buyer, the Fed, out of the market now. QE has ended, right?
That's exactly right. So the question is, are they going to signal more rate hikes? I think they're going to do 4, and then they'll be data dependent. When are they going to start to reduce the balance sheet? That, to me, is a bigger question. And right now, people expect it to be the summertime. Maybe it's sooner. Maybe their hands are forced to do it sooner.
Do you see the inflation fever breaking this year or not?
I don't. I mean, I don't think we're going to stay this high, but I don't know any CEOs that have told me that the supply chains are getting fixed anytime soon. That's what's going to help inflation. And then also the higher rates. But you know what? 4 interest rates, 7 interest rate hikes, that's not going to slow the economy very much. And it's certainly not going to slow inflation. It's the supply chain issues that have to get resolved. So
let's move to some investments on this day where the Dow has turned negative that might offer some port in a storm. We're going to begin with American Express, which is experiencing, I guess, a bit of a post-pandemic comeback. It also has a rising dividend. These are qualities that a lot of folks are saying are important these days.
Absolutely. And these kinds of times, I just put my blinders on and just try to focus on good quality companies, good balance sheets, free cash flow, dividends, buybacks, reinvesting. That's what these guys are doing. Remember, they beat on their last quarter earnings, revenues, net interest income. They also had very strong fee income growth. And we got January data on U.S. loans up 19%, led by the consumer up 16%, and small and medium businesses up 29%. Their customer mix is very healthy as of now. But when they have their analyst day on Wednesday, I want to hear how confident they feel going forward. They just raised total revenue growth to 18 to 20% for the long term. So I like this one a lot.
Wow. What about FedEx and Accenture right now, Steph? Why those names?
Yeah, well, now FedEx, I don't own either of them. FedEx, I don't own, but it is cheap, Kelly, at 10 times earnings. I want to listen to their global outlook. That's a real good, this company is a real good proxy for that. You've got a positive and a negative. You've got positive surcharges that went into play in November. That's positive, and that's a tailwind for them. On the negative side, it's margins. They can't seem to get TNT and the synergies right. B2B also is sluggish, but that will help margins. 10 times earnings, but they have to execute, and margins will be key. Accenture, I want to own this one so badly. It's down 25%, but it's trading at 29 times earnings. And 29, the market doesn't want 29 times earnings. But this is best in breed. It's enterprise spend recovery. It's their outsourcing business that's on fire. And I just think, and the free cash flow. And they're also starting to get pricing power, too. So that's what I want, just cheaper.